Ready? Wow. You don't see me, right? All right, there we go. So 3:01. Sorry I'm late, everybody. Appreciate you coming in. I'm Jerry Slusowitz, your host for the next hour. And again, a little housekeeping. If this is the first time you're joining us, I guess I'll give you a background, I guess, instead of housekeeping. I was featured on Sorbet Magazine month of May. And if anyone wants to get a copy of this thing, I'm on page 22. Very nice article about how we do business, how we help people. I've been doing this for 35 years, maybe a little bit more than that, helping people, when it comes to their finances. This is my monthly webinar. Many of you are clients, some of you aren't, doesn't matter. This is educational for you, your friends, family, anyone who wants to learn anything. At the bottom, you'll see chat, and you'll also see Q&A. If you go to either one of those, put a question in, I'll try to get it as we go forward in the hour. If it's something I'm getting to, I'll let you know, but you can ask me a question every time, but clicking on chat and sharing that, or clicking on Q&A, and I'll get to your question. Look, I assume you're all here to learn, which is why we're all here, because you want to solve some sort of financial problem. This one today that we're talking about is, how markets and investments work. We're going to cover how stocks, bonds, a little bit, tiny bit on options, how they work. If anyone has further questions, you can call me on options. I don't want to get caught in the weeds on that. Okay. Secondly is, oh, Jim, I didn't have to take a driving test. They just gave me my whatever universal driving test as it worked out. So yeah, I'm good to drive. Thank you, Jim. Again, any more questions, just chat or Q&A. But the bottom line, we talk stocks, bonds, and options. We talk a little bit about annuities, the types of annuities, how they work. There's a tremendous amount of misinformation about annuities out there. Some people love them, some people don't. But if you know anyone who has a pension or anyone who took the long-term payout on a lottery winning, those are annuities. So, anyone who has a pension, it's an annuity. So, some people are, I hate annuities. Ask them if they have a pension. If they say yes, and you hate your pension? No, of course they don't. We'll talk about that. We'll talk a little bit about Social Security. I've got this Boomer's Guide to Social Security. If you're not on Social Security, you haven't taken it yet, two things. One, text us, email us, I guess email, there's no text. Nancy, email my assistant, nanci@pfpinvest.com. PFP is Pacific Financial Planners, then the word invest.com. And we'll send you this. And the other thing is, second thing about Social Security is that if you haven't taken it, especially if you're married or second marriage or whatever, divorced, widowed, widower, call us up. We'll run a free Social Security report for you. And people go, oh, Social Security means nothing. It means a lot. I mean, if your average pay is $2,000 a month, so I use this right now, so $2,000 a month times 12 months, it's $24,000 a year, and you live 20 years in retirement, that's $480,000. Now, if there's two of you, you're talking about $1 million decision. Anything got to get that one right? So we're going to cover that, and then investment basics, what makes a good investment plan. And then, as I said, we'll take any questions. We're going with the chat or with the Q&A. Okay. Be happy to talk about it. So I want to start with the stocks, bonds, and options. So stocks is the stock market. And I know a lot of people are in the stock market because I look at portfolios all the time. And they've got money in the market. I mean, people are addicted to it. There's articles that are written about that. And why is that? Why with markets being so unpredictable are people addicted to the market? Especially when it comes to when you're in retirement. If you're 25, if you're 35, 45, stay in the stock market. Okay. Dollar cost average into your mutual funds or your ETFs. You got plenty of time. But if you're within 10 years of retirement and you're already retired or way post-retirement, at that point in time, you got to look at your addiction to the stock market and see if it's warranted. For some of you it is, for others it's not, okay? It depends on your situation. Because markets are unpredictable. Many times it doesn't even make any sense. I mean, we've seen companies who, announce their earnings went up 75% year over year. Last year they earned $1, this year they earned $1.75. And you think, wow, the stock should go up because they're growing their earnings. But if that's the outcome of earnings, okay, that's the news. And the prediction, if the perception of what the earnings were going to be was $1 more, so $2 a share, then the market moved based on this perception that they were going to earn $2 a share. And when reality came in and they only earned $1.75, even though it's 75% better than what it was last year, the perception was $2, which is $1 more than last year. That difference between perception and reality is where the market works many times. So there's websites like earningswhisper.com. There's, on my Market Smith charts, they tell me what the expected earnings are. There's ways to get the earnings expectations so you understand when earnings come out. So there's other times that they expect they earned $1 last year and they expect earnings to be at 50 cents. They were really bad, and they come in at 75 cents. So they lost 25% on their earnings from $1 down to 70 cents. You'd think that that's bad. But yet, because the perception was that the earnings were going to be 50 cents, the market rallies, the stock rallies. The stock goes up on bad news sometimes and goes down on good news sometimes. And people are left to wonder. They go, well, what happened? How'd that happen? Well, those three factors are the things you've got to know. So there was a quote that I use all the time that says, successful investing is anticipating the anticipation of others. That's that perception part. If they're anticipating some move and I have this feeling that your earnings aren't going to be as good or earnings will be better than what they expect, I can anticipate that things are going to be different than what the crowd thinks. You've heard this before. So John Templeton, Franklin Templeton Funds, a very famous guy, he said if everyone's on one side of the boat, it'd be like this, because everyone would be on this side, and run to the other side. Meaning don't follow the crowd. Warren Buffett's famous for saying that. So, like kind of me this year, I've been saying, gosh, I think we had a recession last year. If we do have one this year, it won't be that bad. The market's playing that out. I said the markets were bad last year. They were. The markets are much better this year. We're not back all the way, but they're much better. And so, and yet the news is, it's negative. Oh, it's coming. Those people who are saying the recession is coming and coming are the same people who a year and a half ago said everything's great and the war broke out in Ukraine and they said, oh, it's way over there. That'll help the military industrial complex and blah, blah, blah. Meanwhile, the stock market, lost 27 to 37% by October, depending on if you're looking at the S&P versus the NASDAQ respectively. So, people think of the market as being a casino then. Okay, it must be a casino. That's what it is. It's all risk. Now, I don't like to gamble. I'll be honest with you. I mean, I've been on straight commission since I've been 24 years old and, I'll be 62 next month. So that's a long time. And, so I work hard for my money and, that life's a gamble for me. So I don't want to go to some crap stable or whatever and lose money. But when I was younger, I will say I did go to Vegas a couple of times. And the thing about a casino is once you put your bet down and now you have the dice or you pull the handle or the horse race starts or the football game starts, you're in, you're locked in. It's an all or nothing proposition. You're either going to win or you're going to lose. And if you lose all your money. And the winning is somewhat skewed. It depends on how much, the odds were. Sometimes if you bet $10, you make another 10, so you get paid 20. But other times you can bet $10 and you get your $10 back plus 2, which is $12. So, but yet when you lose all the money. Okay, so that's kind of a difference. The casino, there's no getting out, and if you do lose, it's a total loss on that particular bet. Now some people say, oh, these guys win, whatever. Sure, there's professional gamblers out there, etc. But with the markets, the difference is this. It's not an all or nothing proposition on most of your investments. So if you start trading options and you don't actually manage your risk, then yeah, you could. But most investments that you and I are going to make in our lifetime, at least going forward, has to be a situation where you manage the risk. You don't have to manage for an outcome. Look, they put you in the Baseball Hall of Fame when you get a bat, a hit 1 or 3 times at bat. You could strike out 2 out of 3 times. But if you get a hit on that third at bat for your whole career, and you're the strikeout king, they put you in the Hall of Fame. Like Babe Ruth and Henry Aaron, the old guys that, my young era, that were the baseball home run hitters, they were also the strikeout leaders. Because why? They were swinging for the fences. And they missed a lot of times. And so they struck out, but they're in the Hall of Fame. They're names that we all recognize. So it's like that with the investment world as well. Warren Buffett does not pick 9 winners out of 10 stocks he picks. That does not happen. Over his lifetime, or any long-term investor's lifetime, like me doing this for 36 years professionally, if we're right half the time and wrong half the time, that sounds about right. Maybe the Hall of Fame is right 55% of the time and wrong 45% of the time. So being wrong on a stock security, stock selection is reality. But what's the difference between a casino and what successful investment basics, how markets and investment work, is you have the option to manage the risk. When it starts going down, again, I'm going to draw this screen share here. Give me 1 second. Hopefully this works. There we go. All right, you got the whiteboard, right? So they say that over time, this is price, go on the upper side here, price, and this is time down here on the bottom, that over time, you would expect if you buy something at 20 and you sell it at 30, and it goes up and down and up and down and hits 30, that's the way to successful investing. And it is. You can't go broke taking a profit. But the problem is what if when you buy it at 20, it starts going to 18, 15, 12, and down to 10? Well, you can hold and say, well, I'm going to hold on and hope. And you're hoping for what? Generally, my experience with people like that is they're not hoping for 30 anymore. They're hoping to get some of their money back to 20, or maybe all of it back to 20, and then they're just going to get rid of it, so they don't lose money. Well, that's a terrible strategy because it's hope. Hope is not a good investment strategy. Other people say, well, I've got time. The market always comes back. Well, it does always come back. But when you're older and a senior, which most of us on this call are probably a little bit older, let me do this. Where is my charting service? Got it. Here we go. Bear with me a second. Is it right on top? Yeah, you see it, but I don't. Hold on for a second. We're gonna try that again. I apologize, guys. You'd think I'd have this thing down. Okay, do you see the S&P 500? Okay, good. So here you go. So this was last year. 48.18 was the beginning of January of 2022, right? And here's December 31st of 2022. So it went from 48.18 down to, on December 30th, it was the final trade of the day was 38.39. Okay, so 48.18 to, when I say 38.39, short-term memory problems here, 38.39. Okay, 38.39. It was down 20.3% last year. And now we went from 38.39 to today, the market ended up at 43.81. So, okay, 43.81. So the market is up 14%. So it's still down, right? You'd think 5%, right? Or 6%. If it was down 20 and it's up 14, it's down 6. Well, let's test that knowledge here. So, because I don't think that that's true. So 48.18 a year ago, okay, back in January, a year and a half ago, is now 43.81. 43.81, and you'll see that the market's still down 9%. That's because of the law of inverse numbers. If you lose 20% of your money, you had 100 grand, now you have 80. That 80 needs a 25% return to break even. And that's why we're still not there yet. But the markets are looking better. And this is what I was talking about. The pundits are all saying negative, negative, negative. Meanwhile, since the October low, the markets look pretty good. You have a low and a high, and a higher low, and a higher high, and a higher low, and a higher high, and a higher low. And now we have a higher high. Now, could it drift back down? Sure. But this uptrend seems to be entrenched and in place. Does that make sense? Okay, good. So there we go. So it's not a casino because you can manage your risk. So what I was talking about is in this downturn, okay, we're back on this share here. Let me see if we can clean this up. You guys see the S&P 500. So here was a peak in December of 21, and then you have a low, which is lower than the previous lows over here. You have a lower high. You can now see that the downtrend, and now you got a lower low. You can see this thing's trending down, and it trended down up until sometime early this year, and now it's trending back up. The lows and the highs keep getting higher. You see an uptrend. So you want to participate when markets are going up. You want to move out of the way when markets are going down. So what do I mean by move out of the way? Well, this is what I'm talking about. Let's go back to our whiteboard. And what I do here is, as opposed to hoping as a strategy, if you use fear as a strategy when you're losing money and you fear losing a lot more money, what you should do is put a stop loss or a safety net at, let's say, around 18, and you can pick whatever number you want. But, this is 10% loss before, if it's not going the way you thought it was going to 30, or your advisor thought it was going to 30, and instead it's going down, there's zero cost to buy and sell. Get out of the way. It was a bad premise to begin with. All right. So manage the risk is what I'm talking about. You can't control the outcome, but you can manage the risk. And it's the same thing. So it goes from 20 to 30. That's outcome one, bad. Outcome two is good. It goes from 20 to 30. If you sell it at 30 for no reason at all, you're kind of saying, I fear that I'm going to lose money now that I'm making money. And me, if I made 50% on my money from 20 down to 30, I made $10 on 20, that's 50%. I hope when I make money, see, it's the exact opposite. Most people have this wrong. You want to hope when you're making money. So what do? You raise the safety net as quickly as possible below these reaction lows, and you have your safety net somewhere in a profit range over and above what you paid, or as quickly as possible to what you paid. So if you lose small. And if you make money, you can win big. So it's not about how many times you're right versus wrong. You could be 50-50 on the right to wrong ratio, but if you make $1 and lose a dime, you're trading dollars for dimes, and that's how you do it, by managing the risk. I know that this, it's not as easy as I'm saying, but you have to manage the risk. All right. Jim asking a question. Huge national debt. Is this bad for the market? Well, you would believe it. I mean, I would too, but the debt keeps getting bigger, and it's been getting bigger for, since Clinton, Bush, Bush 2, Obama, Trump, Biden, Democrats and Republicans. Boom, boom, boom. The debt just keeps growing. Somebody say, oh, but it grew bigger under the Democrats, or bigger under the Republicans. Whatever. The debt keeps growing, the markets keep going up. Japan's got national debt as a percent of GDP bigger than ours. Still seem to be working. It really is amazing to me. Let me see. Are you getting this new share? Are we back to this chart here? So here's a Japan exchange traded fund. It was 47 at the beginning of the year. Well, in October, and now it's 62. They got bigger debt than we do, Jim. So do I think debt's bad? Sure. Has the market decided that it's bad yet? No. So since it's doing all this in light of all the debt we have and increasing debt, and this is Japan, by the way. I showed you the US markets. then I don't know, I'd say we still have further to go. Now, those are government policies you gotta write your congressman about, but the bottom line, you can see that this thing's going up. And this is that iShares Japan EWJ. I'm not making a recommendation. The question was about national debt. I was comparing the US national debt to Japan's national debt, and I used the ETF. So you want to buy it, get a second opinion, call me 800-449-9501, whatever you want to do to figure out if that's, if that's something that's right for you. All right. So people say, well, I'm long term. I got on this subject and I stopped off of it. So let me go back to it to finish my point. So here we are, hopefully on back to the market picture, correct? S&P 500. So here we are. Now I'm showing this. Down here is the dates. That's the year 2000, right? 2001 at the bottom, 2002, 2003. You follow that? Here's 2008, 2009. Look at that drop we had here. But if you look, where we were at the beginning of 2000, 7.5 years later, Halloween of 2007 or 2008, we were back at the same level. It's 7 years of no return, okay? This is recently, 7 years, right? Now, what happened is this was a 50% decline here. And then this was almost a 60% decline here from 2007's peak to 2009's bottom. And then what we have? We had another from 2000, let's call it 7 until 2013. So now you got 7 years plus 6 years, which means 13 years of no growth. So the market comes back, yes, but the index changed names. Many companies like General Motors went under during this time frame. General Motors used to be, look at this, see this General Motors stock? Well, no, they didn't go under, they're still trading. That General Motors that came out at the end of 2010, right here down at the bottom, that's not the same General Motors that was around from 1900 to 2008. That company went bankrupt. Everyone that invested for the long term in General Motors lost all their money, all of it. Well, I'm holding on for the long term. To what end? General Motors, I'm from Michigan originally, used to be a saying that said, as GM goes, so goes the economy. General Motors was the largest employer in the United States. Nobody, including the US government, employed more people than GM did. Chevy, a division of General Motors, was the size of Ford Motor Company, all of Ford Motor Company together. I'm not saying General Motors better. I'm just telling you the size, the massive. It was the Microsoft, the Apple of today. General Motors was in the 40s, 50s, 60s, 70s. And yet they went up. So, and yet it was a 13-year period of time where you didn't make money in the S&P 500. 13 years. So how old are you today? And add 13 years, because this can happen again. To reiterate that point, let me go back to the S&P 500. I'm going to have to start speeding up a little bit. You can see here that after this bottom in 2008, 2009, actually, we had a great run. Okay. To 2022, basically through inclusive of 2021, it was about 13 years of up market. Yeah, you had your little COVID crash in here, but it all came back within the year. Now that we've had a 13-year zero return, and now we've got a 13-year uptrend, what's the next move? What does your gut tell you? We're going to go up faster and harder, we're going to go sideways, or the next move is down? If the next move is down, why are you in the market unless you have some sort of risk management plan in place? Because you've got to learn to manage the risk. You want to manage risk, not look for outcomes. It can be controlled. Being a long-term investor, I'm a long-term investor. Do I hold anything? Have I held things for 4, 5, 6 years? Absolutely. In a good economy, when it's going up. But do I hold things forever that are stock oriented? No. You can hold an annuity because it's guaranteed. You can hold a bond to maturity because the issuer guarantees the return of capital. The issuer does. Same with an annuity. The insurance company does. Okay. So that buy and hold about GM, the railroad industry. Here's an example. Unfortunately, I don't have this. I didn't pull it up in time. Here's my list. This is the Dow Jones Industrial Average in March 1920. I was hoping to go 100 years ago. So that would have been, June of 23. But here's the composite of the Dow Jones Industrial Averages 100 years ago. American Can Company. I wonder how they're doing. American Car and Foundry Company. American Locomotive Company. Here's another, Baldwin Locomotive Company. These locomotive companies, they didn't do very well. If you remember, I'll be 62 next month. When I was a kid, the railroad industry was in disrepair. Railroad tracks everywhere, because they came out with the trucking industry, created interstate highways in the 50s, and the truckers started shipping things point to point, destination to destination, right to the warehouse, right to the grocery store, as opposed to trucking it to someplace to have to unload it somewhere. Training it, putting it on a train somewhere and unloading it. Now we're back to trains again, ever since we gave up the port down in Panama to get the stuff from Asia to the West Coast ports, and the stuff from Europe and Africa to the East Coast ports, and then they train it around. But that all started in the last 20 years ago. All the companies from 100 years ago that were in the locomotive industry all went bankrupt. Here's another one. Studebaker. Anyone own a Studebaker out there? Raise your hand. You got a Studebaker? Probably not. They went bankrupt. So, Utah Copper Company. There are a few. The Central Leather Company. No, Central Leather Company. Leather, to buy belts to spank your kids. I don't really know what they did. American Smelting and Refining Company. They're melting metal. Look, we've gone from an industrial society to mostly a service society. Smelting, they do that in China. We offload that to Mexico, places like that. We're not doing that here. American Copper Mining Company. If they're looking for copper here, probably in Australia, New Zealand. It might be a US-based company, but that's not true. So the bottom line is only 1 in 6 have withstood the test of time. General Electric, BF Goodrich, Western Union, American Telephone and Telegraph, AT&T. That's it from 100 years ago. Change is certain. Expect that the markets are going to change going forward. And so therefore, when you're investing for the long term, there's going to be a lot of pitfalls unless you have a risk management in place. All right, John, another different channel. That was Jim, I guess, earlier. Would you please define the difference between an investor and a trader? Well, I think that investing is something you're doing to make money over, with a sensible investment plan over a long term. Whether you're looking for income or growth, you create a strategy, and that's going to be a little bit later. We'll talk about that, which is why I got to start speeding up a little. Where a trader doesn't really care about an investment plan. They're not trying to solve like, hey, I'm giving up my paycheck, I'm retiring, I've got X amount from Social Security, I got a little bit of a pension that's going to give me $5 grand a month, but I need $7 grand a month. I need to invest to get $2,000 a month to supplement my retirement out of my retirement plan. That's an investor. A trader is going to say, hey, look, I'm going to take a portion of my money and I'm going to go in the market and I'm going to buy and sell and buy and sell. And maybe you can buy and hold. That doesn't matter. You can still be a trader. You just don't trade that frequently. But the strategy is more all about this money that's in the market versus an investor is looking holistically at the entire need for your retirement. That's what an investor does. They're looking at the entire need. Where's your income sources coming in? How stable is that income? Is it a pension that's going to continue to pay? Great. Do they have COLA built-in, cost of living adjustments on that pension? They do on Social Security. How much is that? Do you have real estate? Do you have mineral rights, or do you have any other types of lottery winnings, divorce settlements? People have money coming in from a lot of different sources. You own a farm somewhere and you're getting royalties off that. Now, how long are you going to get those royalties? Do you know? Is there an expiration date on this stuff? Is it something going to sell? Is it going to be a liquidity event? That is how you invest to make up that shortfall between your income that you're getting that's solid, and your expenses that you need. And even if then you don't need any because your income's greater than your expenses, you could still be an investor saying, hey, look, I want to invest my money so down the road, if I need it, I've got a bigger plan in place when you're an investor, where a trader is just buying and selling. That's my definition of the difference between investor and trader. Hopefully that answered everybody's question. I thought that was a great question. I really did. So thank you for that. Appreciate John. All right. So, and again, an investor is gonna, the trader is more the casino, let's buy this, let's do this and that, let's get in, let's get out, let's make quicker hits. Where an investor, they may get in and get out, but that's because when they got in, it didn't work out the way they wanted to, so they got out real quickly because it wasn't up to expectations. Because the minute it starts going against you and you say, well, yeah, but I'm going to be an investor, I want to hold on to this thing. No, you are, someone who really just doesn't want to take the responsibility that it wasn't working, and don't let it affect your ego. Don't let, look, stocks go up and stocks go down, and Warren Buffett's right maybe 50%, 55% of the time. Who cares what your right to wrong ratio is? Just don't lose a lot of money when you're wrong, because sometimes it takes years to make that up. Yeah, you get a tax deduction, but that's not really important. And again, I showed you the 2014. If you go back 1980 to 1982 to 2000, you had an 18-year run. It was pretty good. You had the crash of 87 in there. You had a little bitty crash in 89. You had the financial thing of they called it the Asian contagion of 1997. But overall, the market kept going up. But from 1966 to 1982, a 16-year period of time, this was a 14-year period of time, 16-year period of time, the inflation years, the market did nothing. There was no growth in the stock market from 1966 to 1982. Every time it got back to the old 1966 level, 3 different times, it went back down. We had 2 Arab oil embargoes. We had a president resign. We had the Nixon wage and price freezes. We had those were the inflation years. Vietnam War, a lot of unrest in this country during the Vietnam War. And then, obviously you had the race riots, etc., simultaneously, school busing, all kinds of stuff. It was a very dynamic time in this country's history. So the point is that, that 1966 to 1982 was no gain. So you go, okay, well, so there's the 2000, 2013, 66 to 82. What about 1929, the crash of 29 and the Great Depression of World War II? 1929 to 1949 was 20 years of no growth in the stock market. So take your age today, and if we go through another 20 years, and I'm not predicting this, please, but if we go through a 20-year period of time where you get no growth in the market, how old are you going to be? That's why investing for income and getting paid dividends and income is really important, all right? When you own a stock, you own the future earnings. It's the greater fool theory. I'm going to buy it at one price, and I'm going to sell it to somebody else at a higher price. You don't own the company. You own the representative, a stock that has everyone's emotions and everyone's opinions. And depending on how much money they have, the more money they have to put either on it or to take out of that stock through a sell, the more influence they have on the price of that stock. People think they own companies. You don't. Warren Buffett owns percentage of companies. I think he owns 8% of Coca-Cola. I think, maybe 10% of Wells Fargo Bank. So he puts his lieutenants on the board. And even then, he's one of many on the board. That's the closest you get to stock ownership, is when you have a gazillion dollars to put on it. I'm assuming everyone on this call doesn't have a gazillion dollars, because if you do, call me at 949-219-0692 right after this webinar, and we need to talk. But the reason is we don't own the company. The stock is a representative of the company that many times discounts things far in advance of things happening. I remember there was this company, I think it was called Fairchild. It was early in my career, and the earnings looked great, but the stock just wasn't working, wasn't going up, wasn't going up, wasn't going up. And the earnings for like 2 years. And then suddenly it was announced that they had all this asbestos related, things, whatever they did. I think they're bankrupt now. Might be another company, the same name, but they went under. because they couldn't, the liability was too great. So, you know, it was something we didn't know for a few years. But the stock was telling you this isn't a good investment. Why? Because it wasn't going up. And it wasn't paying a dividend back in those days either. It's really the greater fool theory. Where with income investments, this is really important. This is kind of one of my main points here, is that, and I know I've shown some of you this before, you know, they've been on here, but people invest for return. They say, I want growth. What they really want is return. But it comes from two sources, growth or income, or a little bit of both. And when you're young, you can go for growth. When you're older, you should make the switch to income. Okay? Why? Because growth is unpredictable. You don't know whether or not it's going to become growth or if that growth is going to turn in a loss. Right? You see this, right? With income, if you just do a real quick analysis of the balance sheet, income statement, you can look at their cash flow. You can analyze it. If it's a U.S. government bond or if it's a corporate bond or a municipal bond, it is very predictable, the income that you can get. It's predictable. It's safer. And since they're paying you every year, some monthly, some quarterly, some semi-annually, some things maybe pay annually or at maturity, but with that predictability, this is safer. Now, when you're young, you should and could take risk. When you're older, you typically don't want to take as much risk. You want something more safe. That's why bonds, closed-end funds, REITs, things that pay dividends can give you a better total return. I liken this to a financial house, all right? Really important. So your fiscal house, if you think about a house, you know, you got this building, a structure, and you know, when you build the house, normally when you build a house, you know, where do you start? You start with the roof up here, with the roof, or do you start with the foundation down here, the base? You're supposed to start with the foundation. I can't even spell, but anyways, foundation. Okay, this is the base. And you should build your base first when you're building a safe house, something that's going to last through storms, bad economic times, you know, death of a spouse, your financial house. You want to have that base in place, right? But the way it works is we build the roof first. The roof is kind of the icing on the cake, okay? It's your risk money. The roof is your risk money. Your base is what you want to have as your protected money. Okay, you want to have that money protected in good times and in bad. You want that money safe down here on your base. But because when we go to work, when we're 22, 25 years old, some of you are going to say, I started working in 16th grade. I did too. I was like 10. Started working for my neighbor and I worked ever since. So, you know, good stuff. But what happens, they give you these 401k, 403b opportunities to save money. And when you're 25 years old, what do? You put your money in the stock market. Okay. Your 401k is all built on growth investment. There's very little bonds and safe investments in those 401ks. Because why? It's designed for long-term growth. So most people built the roof before they built this base. Probably most of you listening right now. I know. Now, these are the walls. And the walls kind of determine, it could be a hybrid between a safe foundation and a roof. Now, you could have the best looking roof, but if it's sitting on the ground, you know, you're gonna get termites, bugs, it's gonna get eaten apart and it won't last. You need a base with walls to hold your roof up. But that, as you age, becomes a smaller percentage of your overall portfolio. The base should be your protected money, which you define as cannot lose or won't lose most of it. You know, you want to have it principal protected. The roof is the risk money, okay? You want growth and opportunity. And yes, you want both in retirement, but you want safety first. And so if you grew up, save, you got $1 million in your 401k. It's awfully tough to say, hey, I want to stay with the girl I brought to the dance. I get that theory, but that's just not right when you start going back and looking at what I was talking about, is that growth can become a loss. I mean, last year, the average investor lost 23% in 2022. Okay. So if, I'm going to round that up to 25%. So if you had $1 million, all right, and you lost 25%, you lost 250,000, and now you have 750. Okay. So the Nasdaq's up 20%. So 20% on 750 is what? 10% would be 75,000. So 150,000. So you're at 900 grand. You're having a great year in the market, and yet you're still down. Why? Because you're hoping for the greater fool theory. You're investing for growth versus having something that paid predictability. You can use bonds. There's all kinds of things that you can use that pay income, or you could use annuities. A lot of people go, oh gosh, it started off with this thing talking about annuities, and people going, oh, I hate annuities. I don't hear about annuities, whatever. Okay. It's a contract between you and an insurance company. All right. Where the purchaser, you pay a premium, whether you pay it in one lump sum or over a period of time, for a payout option. So it's for payout later. And you can get that money income for a set period of time, 3 years, 5 years, 10 years, or a lifetime. Many times, so there's the accumulation period and the distribution period. And there's two basic flavors of annuity, types of annuity. One is income, immediate income. That's your pension. You retire, they give you an annuity, they give you a pension. You win the lottery, you take the payments over 20, 30 years, they give you an annuity. Okay. You want income for the next 5 years and you've got money, you can take, you got something that's coming in down the road, you're going to sell, your Aunt Betty's house because, she's dying or whatever. So you take 100 grand, you put it into an immediate annuity, and in the next 5 years, they're going to pay you out some number greater than 100,000, and you can take that money every single month. And then a year, 5 years later, you get 100 grand from somewhere else. If you have some growth investments that grow back up, you can keep repeating that to give yourself more income. Okay, so there's the accumulation phase and the income phase. An income annuity or an immediate annuity is all about paying immediate income. Then there's deferred. So you don't want the income now, you want it later, but you want to be able to get it when you want. And there's 3 types of deferred annuities. There's fixed rate. This is the easiest one out there. You buy into an insurance company, much like you buy a CD, but instead of FDIC insured, it's insured by the insurance companies, reinsured by other insurance companies, who's backed by the state guarantee fund of the state you live in. So if you're not here in California, not backed by the California state guarantee fund, it's wherever you purchase it. So I'm licensed in many states. It depends on your state guarantee fund, how much that is. But the point is that these are really safe investments. I mean, raise your hand if you have car insurance. I'm gonna see the hands up because I can't see you guys. All right, so how many have homeowners insurance or renters insurance? Most people. How many have health insurance? Most people. Even if it's Medicare, you got health insurance. If you got a supplement, you got double health insurance, right? And then people, well, I don't know about annuities. It's the same concept. Instead of insurance on your health, insurance on your car, insurance on your home, it's insurance on your retirement money. I don't get how people go, well, annuities been around, the insurance has been a concept that's been around for thousands of years. The farmers on one side of the mountain said, hey, look, if we have bad weather, can we share in your crops in the year we have bad weather? And they said, yeah, but if when we have bad weather and our crops get destroyed, can we share in your crops? And they kind of reinsured each other. And that's what happens with insurance companies. They all reinsure each other. So of those 3 types of deferred annuities, the set rate, if you go for an income annuity or fixed income, like you get 5% for 4 years now. I think it's maybe 4.95 for 4 years and a little over 5 for 5 years. All right. You want to go 3 years, I think it's like 4.3. So, there's different rates that you can lock in that every year they're going to pay you every day you make money. Can you pull money out? Most allow you to take out 5 or 10% of your money per year. So if it's paying you 5 and you're taking out 10, you're obviously taking some of your own money out, but the money's safe, it's fully insured. An index annuity, similarly, your principal's insured, you can never lose money, just like a fixed rate annuity. But the rate of return is based on some index. And now everyone knows that stocks are the best place to make money over a period of time. It is. Over the long-term stocks, really make money. Someone's going to say, oh, no, real estate. Yeah, well, real estate makes money too, but you're leveraging your money. So, but if you put 100% of your money and pay for real estate versus stocks, the stock market does better. If you put, buy $1 million home with $100,000 down payment, and it goes up 10%, it goes up 100,000 on $1 million, you've doubled your money. That's why real estate looks attractive, because you're using leverage. But the stock market goes up quicker historically than the real estate market. And I'm not bagging on real estate. I own, extra real estate besides my house. So the point is that so your money's guaranteed with an index annuity insured, but the rate of return depends on an index. You participate in some level of the upside of the market. Right now, these upside participation, if you look historically, the S&P 500 returned around 9.5% per year, and you can have these caps where if it returns anything up to 12%, you make all the upside on the market. Those are really good. Index annuities are great right now, right? But if it goes down, you don't lose. So if you bought the Vanguard S&P 500 fund and it goes down 50%, you lose half your money. If you have that money in annuity and you have it in the same S&P 500 and it goes down 50%, you still have all your money 1 year later. And then you're buying in at the down 50% level, participating in some level of that upside. So they make a lot of sense. It's the only financial product that can guarantee income for as long as you live. And it's backed by, again, the financial strength and claims paying ability of the insurance company, which there's a lot of high-end insurance companies. So again, fixed annuities offer not only protection of principal, but protection to earn a set rate. You know what that is. And an index annuity, you got protection of principal, but you're playing, well, what will I get? Historically, you'll get more in an index annuity over a period of time than you would on a fixed rate annuity, historically. The last flavor of deferred annuities is something called variable annuities. Those are the ones you get the TV commercial says, I would never buy an annuity. Or annuities are high in fees and high in costs, because the fixed and index annuity, unless you're buying some rider, which most times you don't need, there's no fee. There's no fee. Now, again, if you got one with a fee, have it analyzed. Before you ever buy an annuity, get a second opinion. Give me a call, 949-219-0692, 949-219-0692, okay? So variable annuities have high fees because now you have an insurance company who hires these mutual fund companies. So the insurance company wants to get paid, they get fees, mortality and expense, operating fees, etc. 1.5% to 2.5%. Then you hire a money manager, they're going to make anywhere between 1% and 2.5%. So now you could be anywhere between 3% and 5% on fees. And then if you buy a rider on top of it, it costs you even more. So those are mutual funds. So if the mutual fund goes down, you can lose money, principal, on a variable annuity. Now, most of them say, yeah, but it's a money back guarantee if you die. Well, if you die, you're insuring it for someone else, not for you. Index and fixed rate annuities, that money's there for you, not just upon death. That's why I don't do variable annuities anymore. I did years ago when I first got licensed and didn't know anything about, index annuities. I did fixed rate annuities all along. All right, so hopefully that answers questions about annuities, but we're going to cover these more over a period of time. That is really, something to know. But, as I talk about this thing, let's talk about bonds, because we're getting close on time. Any questions, start throwing them in there under either Q&A or chat, all right? Bonds versus bond mutual funds. I know I've talked on this one before. We're going to go back over to the share screen here, and we're going to go over to here, all right? So with a bond, you get two guarantees from the issuer. Bonds are issued at $1,000 per bond. Generally, that's what's called the par rate, the nominal rate. And at maturity, you get your $1,000 back. It's backed by the full faith and credit of the issuer. If you have a corporate bond, however good the corporation is, that's why we stick with, high-end bonds, IBM, Intel, Goldman Sachs, big companies. But, if you buy a junk bond, well, then maybe they don't pay you back. But if you're dealing with the US government, you're dealing with a municipality, muni bonds, because you're in a high income tax bracket, then it's backed by the tax collecting ability of the United States or that municipality, generally speaking. Now, as I've talked about this before, as interest rates go up, this is interest rates, as rates go higher, the price of the bond drops, the price goes down. So if you buy today and rates continue to go higher, it's possible you can go lose money. Now, some people are saying, well, gosh, the interest rates might go down, so then you might make money. It's going to fluctuate around, but no matter what, no matter how high rates go at maturity, the issuer is going to give you back $1,000. That's why it's predictable. The other thing is, based on the quality of the issuer, they're going to pay you a set amount of income, set rate of income over the time that you own that bond. And it's consistent, et cetera. And it depends on the issuer. So you stick with good issuers. So you have two guarantees by the issuer: guarantee of principal and a guarantee of interest. That's on an individual bond. In this country, a lot of my colleagues, including some really smart people on TV, radio, et cetera, they're confusing bond mutual funds that they work the same way. They don't. Bond mutual funds don't work like that. With a bond fund, when you buy it at a set price, you have no idea if this thing's going to go up or down. You have no idea. Okay. And if interest rates are going higher, the price is definitely going down, which is what we saw last year, one of the worst years in 40, 50 years for the bonds. Okay. The other thing is, when they pay you, you don't know what they're going to pay you. So you lose the principal guarantee, you lose the guarantee of income. So what do you really own? The definition of a bond mutual fund is the stock of a company that issues bonds. So you're owning stocks, so more or less, those have risk. Now, because interest rates for most of our lifetimes, of investing lifetimes, because some of you are older than me, but from 1982, when we had the 20% CDs, 19%, 17% mortgages, to 2021, when we went down to 0.5% on a 10-year treasury, rates were doing this. They were going down over a period of 40 years. And then when we got to less than 0.5% on the 10-year treasury, the 10-year treasury has been issued since the founding of this country. Since the founding of this country, 247 years ago, it's never been below 1%, the 10-year treasury rate. Yet it went below 1%. It went down below 0.5% in late 2021. So when you're on the South Pole, it doesn't matter which direction you go, it's up. And that's what we've seen. We've seen interest rates start to go up and to go higher. And so when you look at it, I'm going to show you this, 0TNX. This is the 10-year treasury. You can see now that this is back in the early 90s. That 10-year was at 8%. It was going down, and then it started to go down quicker, and then it fell off a cliff in COVID in 2020. I was wrong. I said 2021 was the low. It was actually 2020. And this is 0.5%. This is 1%. And never in the 247 years prior to 2020 was it ever that low. That's why I called it the South Pole. So people who own bond mutual funds, what are you doing? Like, it's not like a stock fund where you can hold on and think that it's going to come back. The only way it comes back is if interest rates go back to this level. I don't see that happening. Like the Fed still say, oh, we got inflation still too high. We got to raise rates more, not less. All right. So when it comes to investments, what makes a successful plan? I'm going to move this further along. You want to have enough lifetime income that you don't run out of money. You need income. See, it's not about how big your portfolio is. It's how much can you draw off the portfolio. Got a buddy of mine, Todd, who's not on here. We've been friends since early college. And Todd grew up a couple miles from my parents' house where I grew up. And so, we became instant buddies riding back and forth to school. and we're friends to this day. Todd's got, I don't know, maybe $750,000 on all his investments that are liquid that like I manage and other people manage. But his house is paid for. He's got, a cabin paid for. He's got boats paid for. He's got snowmobiles living in Michigan paid for, trucks, vehicles. He's got all this extra, all the toys you want, canoes, everything, hunting equipment. His lifestyle cost is low, so his need for income is low. He's earning more on his investments than what he needs to take out in income. Plus, he's got a little pension and he has Social Security and he has no debt. I got another gentleman who lives in Malibu. All right. This guy just sold his business for $20 million net. What do you got? He's going to run out of money somewhere between 20 and 22 years. He just netted $20 million. He's 73 years old. Now, he might die before that, but if he lives to 93 or 95, he might run out of money. His wife, who's 69, has a bigger problem because she should live longer than 20 or 22 years, but because their lifestyle is so robust, the income generated, if we get him 7% income on that money, he's going to be broke in 22 years because of his lifestyle. So what makes a good plan is having enough income to last your lifetime, to meet your basic needs. And we've talked about this before, but I mean, for those of you who are new on here, I do want to show you this because I think it's very important, is that you have this basic little chart. You have your income coming in here, whether it's Social Security, pension, it's supposed to be pension, RMD, and any other sources of income like real estate, etc. All this money is on your income side. It creates a dollar value. And then you have your expenses over here. And this is the part that you need to work on. How much do you spend? You want to be a good investor? Know this number. Because if it's less than your income, then your assets down here, all your investments and your savings, you can kind of ride things out. You can grow your money. You can take maybe a little bit more risk because your income needs little. But up to me, if you're retired and your income's greater than your expenses, I would be safe with your assets to make sure they're there should you need them, because things like inflation are going to come along and raise those prices. Because if inflation comes along and your expenses are greater than your income, then your rate of withdrawal, your percentage withdrawal off your money, off your assets, will predict exactly when you're going to go broke. Now, I do these analysis all the time for people. I call it the retirement risk report. If you want a retirement risk report, call right now for, we can do this over the phone, we can do this on Zoom, and we can do it in person. And it's free. I'll give it to you. And you need to know what your spending is, because if you're drawing this down at a higher rate, you might go broke in 10 years. That might not be good enough for many of you, just like this client in Malibu. My buddy Todd's not going to go broke because he's not withdrawing. His rate of withdrawal right now on his investments is 0. He's not. But if you start drawing money and it's below a certain threshold, let's say, they say 4%, could be as much as 5%, depending on how much income your portfolio generates. But the minute you cross that threshold where it's more than what the portfolio is generating, you're starting to drain down principal. Some of you are going to run out of money in 40 years. What are you saying? Well, geez, I'm 75 years old. I know, 40 years, great. I'll be dead by then. Okay. But that's what makes a good investment plan. We are kind of out of time. I'm going to continue on for a couple of minutes to finish a couple subjects here that I wanted to cover. But, I did say 1 hour. I'm sorry to get to everything. I will cover some of this in our next meeting. But you can ask questions if you want or drop off. It's fine with me, but I wanted to cover Social Security. I get asked all the time, will it last? And again, if you join late and you're not on Social Security, either have us run a report and we'll send you this guide for Social Security. Because if you're not drawing on it, it means you're definitely a baby boomer. Because everyone else started drawing at 70 at the latest. So the point is that people ask me all the time, will Social Security last? Yeah. As a matter of fact, at its current pace, if things change in 2033 or 2034, another 10 or 11 years, it'll go to 75 cents on the dollar if they change nothing. But in 1984, we were faced with the exact same situation, same questions. Social Security's going to run out of money. So they did three things. They raised the retirement age. If you remember, retirement age was 65. Now it's 67. I'm 62 pretty much, and I got to wait till I'm 67 to get the same benefit that someone 50 years ago was getting at 65. So you get full retirement, you got to wait till 67 now. They moved it back a couple of years. What did it do? It made the Social Security pool last long. Second thing they did is they raised the taxes. So you're paying 6.2% and your employer is paying 6.2% on every dollar you make. So if you're self-employed, you're paying 12.4% on every dollar you claim on your income taxes. You got to pay Social Security income, from earnings. And that's been for the last 50 years. They could just raise that tax, which is what they did in 1984, 1%, not total, not to 6.4, 6.2 to 7.2. No, that 12.4 to 13.4, however they get there, stick the employer, stick the employees, stick both a little bit each. Problem solved just with that. Change the retirement age, problem solved just with that one issue. Problem solved if you just raise the tax a little, just one issue, one way to solve it. Now you got two ways to solve it. And the third thing is Social Security, you're only paying tax on your first, I think it's about $156,000 worth of income. Okay, most people don't make that. Only 10% of people make more than $156,000 a year. So those people are paying tax on all of it. But there's 10% of people, someone make $250,000, $500,000, $1 million, $10 million a year, and they stop paying that 12.4% on Social Security at, let's say, $156,000. Take the cap off. See, what they did in 84 is they started escalating the rate. We'll escalate it further, just take the cap off. Make wealthier earners pay that 12.4% on. If they make $10 million, they got to pay it up $10 million. You know what? That alone would solve the problem. So there's three easy ways for Congress to fix this problem. Do I think they will? I do. When do they have to fix it? Sometime between now and 2034. When do I think they're going to fix it? Very close to 2034. In the meantime, there's going to be all these scare tactics and all this kind of stuff that really just misconfuse, people out there. But if you haven't taken Social Security, I do have a report that we can run based on your numbers, especially if you're married, because sometimes the difference between the best way to take Social Security and the second best way to take Social Security is a difference of $100,000 over your lifetime. I'll run the report for you. Call our office, 949-219-0692. If you're already on Social Security, don't call me. There's nothing I can do. You're already on it. If you haven't started, you want to start, you want to get on Social Security, and you want to maximize that. All right, hey, we had another question. Precious metals are part of the portfolio. Jim, I don't believe in that. I think commodities are got to be part of the portfolio, especially when there's inflation. Commodities can do well. But as far as gold and silver, we're not going back on the gold standard. We're not going to be running around at Home Depot with a wheelbarrow full of gold or a wheelbarrow full of silver. The kings and queens were going with guards and armed guards on their horses when they went on vacation because they had all their gold with them to go on vacation. Come on, is it tradable? Sure, tradable. The greater fool theory. Sometimes it'll be good, sometimes it'll be bad. Just like the Bitcoins of the world. Look, the United States government, Chinese government, they're all going to come up with their own controlled electronic currency. They're going to have their own digital currency. Remember, only 2% of all the currency out there is paper currency. Credit cards, electronic transfers, we're already kind of there. But this decentralized finance, DeFi was how they found all these Bitcoins of the world and Ethereum and all that. No, what do they think? They're going to let Jack Dorsey choose the value of money? No. Or it's going to be based on the markets? Well, if that's the case, remember Bitcoin was I think like 75,000 not too long ago and went down to 15,000. You don't want your money to be that crazy in terms of fluctuating value. Can you make money trading Bitcoin? For some of you who want to do that and aggressively trade your money in precious metals, go ahead. It's a trade, but it's a gambling trade. It's a risk trade because they pay no income. I mean, a piece of gold right now just sitting here. I got gold sitting right over there, actually. Don't steal it. It's so flaky and tiny. It's not worth anything. So don't you have to break in my office. But the point is that it doesn't produce anything. It doesn't do anything. It doesn't create anything. It's not like, McDonald's where they're serving, a billion hamburgers a day or a year or whatever number of hamburgers they serve. But the bottom line is that, I don't think it's a good investment. That's the answer to that question. All right. So guys, we did cover a lot today. I didn't cover anything on options. We didn't cover too much on the world of income other than having a good income plan is what you need. We covered annuities, stocks, bonds, mutual funds, how to manage risk. We talked a little bit about annuities. We talked about the fiscal house, and we talked a lot about Social Security. So, and we talked about how markets change over time. So I think we covered a lot of this. I tried to answer all your questions. I don't see any more Q&A or chat. Anybody? Nothing? Hey, look, guys, appreciate your patience. Thank you for sticking with me. Sorry we ran over. We're doing one next month. It's going to be July 25th. There it is. Yeah, July 25th. Mid-year market report. All right, and we'll talk a little bit more about some of the stuff we covered today. Okay, tell your friends. This is free. There's no obligation. If you want free help, give me a call. Be glad to help you. But it's up to you. If you're doing well on your own, great. But if I can help in any way, 949-219-0692. All right, guys. Thanks again. Tell your friends. Have a great day. See you next month.